Today, we're diving into a technique that the big quant funds use to see the invisible forces moving your portfolio. We're going to find the hidden risks that are really driving your returns. And trust me, the answer is probably not what you expect. Let's jump right in. So, you've done everything right. You've bought a bunch of different stocks, maybe some bonds, you've diversified. But here's the real question. When the market makes a big move, do all your assets kind of move together anyway? Where is your risk actually hiding? Well, the answer is often a huge surprise. Your risk isn't nicely spread out across all your investments. Nope. Instead, it's usually concentrated in just one or two really powerful underlying factors that are hiding in plain sight. To find these factors, we need a special kind of tool. I want you to think of it like an X-ray for your portfolio. This tool is built on a couple of concepts from linear algebra, but don't let the names scare you. Eigenvalues and principal component analysis, or PCA for short. Okay, let's not get bogged down by the textbook definition. An eigenvector simply points you in the direction of the biggest wobble in your portfolio. And the eigenvalue? That just tells you how big that wobble is. Together, they find the single most powerful source of movement. Here's a fantastic way to think about it. Picture a rubber sheet with a bunch of dots drawn on it. Now, if you grab the edges and stretch it, the dots move, right? The eigenvectors are the lines on that sheet where the stretch is the absolute strongest, and the eigenvalues just measure the force of that pull. We're just looking for the biggest stretch in your portfolio data. So, how do we actually apply this? Well, that's where principal component analysis, or PCA, comes into play. PCA is like a machine. You feed in all your messy, tangled up assets that seem to move together. It then uses those eigenvalues we just talked about to spit out a few simple, independent risk factors, revealing the true structure underneath all the noise. The process is really amazing. We start with what looks like chaos, all these individual stocks that seem to be connected in complicated ways. Then we hit it with this PCA X-ray. And what it reveals is a super clean, simple set of underlying drivers. So instead of tracking a dozen different stocks, you might find you only need to watch a couple of core factors. All right, enough theory, let's make this concrete. We're going to run a case study on a pretty common investor portfolio and see what this PCA X-ray can actually show us. Okay, here's our sample portfolio. It's got 40% in the S&P 500, 30% in the NASDAQ 100, 20% in small cap stocks, and a 10% slice for long-term government bonds. It looks pretty diversified on paper, right? We've got different stocks, different company sizes, and some bonds. But is it really? Let's run the numbers. And boom, here's our first big result. The very first principal component, which we'll call PC1, explains a whopping 66.5% of all the daily movement in this portfolio. Just let that sink in. One single hidden factor is driving 2/3 of all the volatility. So what are these mysterious components? This table here with the loadings is basically our decoder ring. It shows us how much each of our assets is influenced by these hidden factors. Let's break down the top three. Take a look at that first column for PC1. Notice how all the stock ETFs, SPY, QQQ, and IWM, have these strong positive numbers? But the bond ETF, TLT, has a -1. This is the classic risk-on, risk-off dynamic you hear about. It's the broad market factor. When stocks are having a good day, bonds tend to go down, and the other way around. Now, what about PC2? This is interesting. See that big negative number for IWM, the small cap fund? While the big company ETFs are positive, this component is capturing the push and pull between large cap and small cap stocks. It's a size factor. And finally, PC3 is a dead giveaway. I mean, look at that massive 0.98 for TLT. This factor isolates the risks that are totally specific to the bond market. So, we've found the hidden factors. But now it's time for the most important question of all. When we look at the total risk in our portfolio, the actual up and down volatility we feel, how much does each of these factors really contribute to that? So what does this all boil down to for our total risk? Well, it turns out that an absolutely staggering 89.2% of this portfolio's entire day-to-day volatility is coming from that very first market factor we found. So even though we're holding 4 different assets, this portfolio's risk is almost completely dominated by the general movement of the market. And this chart just lays it all out there. That huge slice of the pie, nearly 90%, is just market risk. All the other factors we found barely even register. So your supposedly diversified portfolio, at the end of the day, it's pretty much just one giant bet on the market. Now, figuring this out is a massive insight, but it's not just some cool academic exercise. This knowledge fundamentally changes how you should be thinking about managing your risk. So here's the bottom line, the crucial point. If you want to meaningfully reduce your risk, selling a little bit of one ETF for another isn't going to do much. You have to hedge the dominant factor. In this case, that means you need to hedge the market itself, maybe with some options on SPY or by adding assets that are truly uncorrelated to the market. Now, if you want to try this yourself, just be careful of a few common mistakes. The most important one, always use asset returns, not prices. We're analyzing movement, not value. You should also standardize your data so that high volatility assets don't dominate the results. And finally, focus on the big components that explain most of the action. The rest is basically just noise. All right, let's just quickly recap what we've learned. PCA is an incredibly powerful tool that can simplify a really complex portfolio down to its few key risk factors. As we saw, a lot of the time, just one or two of those factors explain over 85% of what your portfolio does. Identifying that dominant risk factor is absolutely key to hedging effectively. And remember, always use standardized returns, not prices, for your analysis. We've pulled back the curtain and found that this diversified portfolio was really just making one big bet on the market. It really makes you stop and ask a pretty critical question. Do you truly know what hidden bets you're making in your own portfolio?